Hello and welcome to another video. In today's video, I'm going to talk about how you can avoid paying tax. Nobody wants to pay tax, and as the famous saying goes, there are two certainties in life, death and taxes. However, in the UK, there is a system where you can avoid paying tax to a certain extent, and this is called an ISA, or an individual savings account. In today's video, I'm going to talk about what an ISA is, the different types of ISA, and how an ISA works. So let's get going with the video. As always, before we get going with the video, please make sure that you hit that like button and hit that subscribe button so you don't miss out on any further videos. So before we jump straight into ISAs, I'm going to have a quick explainer to help you understand exactly how tax can impact your long-term investments. You might be saying to me, actually Anthony, I'm not earning enough money or investing enough money to be taxed on capital gains or dividends. However, you might not be taxed right now. However, moving into the future, if you're a long-term investor, you may be taxed. So the two tax rates in the UK are capital gains tax and taxes on dividends. First is capital gains. Capital gains is when you buy something low and sell something high. On that gain, you get taxed. And in the UK, there is an allowance of £12,300. Once you go over that allowance, however, you'll be charged 20% tax. There's also a dividends tax, and this is a tax on the dividends that a company pay you. Right now, there is an allowance of £2,000, and the tax rate can vary from 7.5% right the way up to 38.1%. Whilst you may not think that it's worth it right now for you to invest that money and worry about the tax gains, if you follow this example where you're investing only £100 a week into the investment market, you'll soon see how in the future you could be taxed. So let's jump into the example. If you're investing £100 a week, you're investing £5,200 every year. And let's say you invest that money away for 30 years. We'll be rather conservative here, and let's say you return 7% per year on your investment. That is significantly lower than the S&P 500 or the FTSE 100, which return around about 9 to 10%. So here you're not taking too much risk and getting a steady 7% per year. So over those 30 years, if you've invested that money every single year, you would have invested £156,000. That's quite a lot of money. Because of the power of time and the power of compounding, investing that money at 7% per year for 30 years, that pot is now worth £490,000. And that's pretty good going for investing the money for 30 years. However, as you see, there's a huge gain between the £490,000 that your portfolio is worth and the £156,000 which you invested. Which means that if you come to 30 years time and you want to sell your investments, cash in and buy that wonderful Lamborghini that you've always dreamed of and have enough spare to buy a house as well, then you'll be taxed on that investment if it isn't in an ISA. This means that if you want to sell your portfolio, which is worth £490,000, you'll be charged tax at 20%. So the gain here is around about £330,000, which means that you'll be taxed over £60,000 on that investment. That's a hell of a lot of money, and an easy way to avoid this is just by putting it into an account where you're not taxed for the rest of your life, and this would be an ISA. However, let's also look at what this money could be giving you as a dividend. Using the same example of a portfolio which is worth £490,000, if we just use the 4% rule, which is a widely regarded rule that is the amount of money that you can pay yourself when you retire and have enough money to live on and have enough money in your retirement account to sustain you through retirement, then you'll be paying yourself around about £19,500. Now, that is far greater than a £2,000 dividend tax allowance, which means that £17,500 will be taxed at the rate in which you earn money. This can be between 7.5% all the way up to 38.1%. Now, an easy way to avoid the capital gains tax and the dividend tax is to put that money into an ISA. As we want to protect all of our gains, what is an ISA? Well, an ISA stands for an individual savings account. This means that any individual in the UK can open an ISA as long as they hit certain criteria, normally meaning that they're over the age of 16 or 18, which I'll discuss in a minute. And that means that any person can invest up to £20,000 per year into an ISA, and that money is shielded from tax. This means that interest payments that you might get from bank accounts or bonds, dividend payments that you might get from stocks, and the capital gains when you buy and sell an investment will never be taxed as long as it's housed in an ISA. There are 4 types of ISA: cash ISA, stocks and shares ISA, lifetime ISA, and innovative finance ISA. First up, we have cash ISAs. Now, the criteria for opening cash ISA are that you have to be over 16 years old and you can invest up to £20,000 into any one cash ISA per year. Cash ISAs are the most simple ISAs as these are just like savings account. However, that money is protected by the tax wrapper that is an ISA, meaning that you'll never get taxed on the money that you put into a cash ISA. There are 2 main types of cash ISA: variable, which tracks the Bank of England base rate, meaning the interest rate can go up as well as down, and fixed, which means that you get a certain fixed interest rate for a certain period of time. Normally, fixed interest rate ISAs have a higher rate of interest than variable rate ISAs. However, with a fixed rate ISA, you have to lock your money away for a certain amount of time and you won't be able to access it to ensure that you get the most gain from investing into a fixed ISA. However, to understand if a cash ISA is really worth it, you really have to look at the interest rate that you're getting on a cash ISA. However, right now, with interest rates at all-time lows, you're really not making any money off cash ISAs at all. The best interest rate that I've found is 0.96% per year, which is probably not even beating inflation. This means that cash ISAs aren't really a good store of huge chunks of money for the long term. A better store of money would be a stocks and shares ISA. Next up, we have a stocks and shares ISA, and a stocks and shares ISA is my personal favourite. A couple of conditions that need to be met is that anyone who's over the age of 18 can open a stocks and shares ISA, and you can invest up to £20,000. Stocks and shares ISAs are great, and as you know, if you've been watching this channel, I always tell people that they should be investing. And in the UK, if you're investing into a stocks and shares ISA, then that is fantastic, as all the gains which you will ever get will be protected and won't be taxed in the future. The beauty of this ISA is that you can invest in actually much more than just stocks and shares. Obviously, you can buy stocks and shares of companies, you can buy into funds, exchange traded funds, but you can also buy corporate and government bonds. And this means that all interest payments, all dividend payments, and all capital gains aren't taxed in the future, meaning that you can withdraw everything when you want to tax-free. Now for me, this type of ISA is my favorite type of ISA, and I recommend that anyone who wants to get into investing and anyone who wants to invest their money should be buying into a stocks and shares ISA. Using the example that I used earlier, when you invested that money and you've grown a pot to £490,000 means that you'll never get taxed on it. All the dividends that you receive, all the capital gains tax that you would have to pay when you come to sell means that you'll never have to pay it. And this is fantastic, especially as you get older, and when you retire, you can withdraw that money and not have to worry about having to work out how much tax you're paying and losing a significant chunk should that money have been invested in a non-tax-free account. So now we've covered the 2 biggest types of ISA, which most people have probably heard of. Next up, we're going to talk about a lifetime ISA. Well, a LISA, or a lifetime ISA, is there to cover people to help them along in certain aspects of life. This is to buy a house or retire. This is the government trying to encourage you to save money. A lifetime ISA is open for anyone who's between the ages of 18 to 40 and means that you can only invest up to £4,000 per year. However, the great thing about a lifetime ISA is that government will give you 25% extra on your money. Should you hit the top £4,000, the government will give you an extra £1,000 to invest. Should you only hit £100, the government will only give you an extra £25. However, that's 25% free money. However, there are some restrictions. You can only withdraw that money for 3 reasons. The first one is that you need to use that money to buy a house. This is only available for first-time buyers. The next way to withdraw this money is to be over 60 years old. This, like the previous stocks and shares ISA, will mean that when you withdraw that money, you won't be taxed on it. And you will get the benefit of the government's bonus of 25% for every year that you invest. And you can invest between the ages of 18 and 50. And finally, the last reason that you can withdraw is sadly if you're terminally ill. And hopefully no one will have to look into that and understand why that works. If you don't hit any of those 3 criteria and you still want to withdraw your money, you will be hit by a 20% penalty, which effectively wipes away the government's bonus. This means that if you need to have that money anytime before you retire or not for your first home, this means they will take the 20% off your portfolio. Now, this is very similar to a pension account, and I've been running the numbers, and actually, if you were to invest in a LISA rather than a SIP, it could work out better for you. So you really need to look into the numbers. The advantage of a LISA over a SIP is that when you retire and you come to the age of 60, meaning you can draw down your lifetime ISA, it means that that money that's held in that lifetime ISA will be tax-free. Although you get a benefit of investing into a pension right now, that when you come to withdraw that money, you will be taxed at whatever tax rate you'll be at. If you've been investing money for the long term and you've built up quite a portfolio and you've been paid a significant amount of money, that actually when you come to retirement, that tax rate might be quite high. And all that money that you've been saving and want to draw down may actually mean that you'll have to pay significant amounts of tax on drawing down that investment. And a lifetime ISA will protect you from paying all that tax, as it will be all tax-free, just like a stocks and shares ISA. Personally, this is something which I think is great, and should you be investing for your retirement, it's something you should really look into. And lastly, we have the innovative finance ISA. This is a different type of ISA, but as at other ISAs, you have to be over 18 and you can invest up to £20,000. This is different as this takes into account the peer-to-peer lending market. Peer-to-peer lending matches investors who are willing to lend money to borrowers who need it. This can be individuals, businesses, or property developers. This essentially takes away the role of the bank. As in a video that I explained earlier, is that banks work by taking your money and then investing it and lending it out to people who need it, such as individuals, businesses, and property developers. Now, this is a higher risk product and should only be used for people who have invested significant amounts of money or actually have a lot of money. This is because innovative finance ISAs aren't protected in the same way in which normal ISAs and bank accounts are. Normal ISAs, such as stocks and shares ISAs and cash ISAs, are protected by the government up to a value of £85,000. However, an innovative finance ISA isn't protected, meaning that if that money gets completely lost or a borrower doesn't pay you back, and essentially your investment could end up at zero. Now, for most investors, this type of ISA isn't really worth it. It's a bit too risky and they're just really interested in investing into the stock market, bond market, etc. However, it's good to know what other products there are out there. And finally, there are obviously some restrictions. So I'm going to really explain the difference between different ISAs and what restrictions there are to investing your money each and every year.
Okay then, so here we have the 4 different types of ISA. We have the cash ISA, stocks and shares ISA, lifetime ISA, and innovative finance ISA. So for each of these ISAs, I put underneath the maximum amount you can contribute into each ISA each year. In the cash ISA, you can only contribute 20k. The max you can invest into a stocks and shares ISA is 20k. Lifetime ISA, the max is 4k, and innovative finance ISA, the max is 20k. I'm going to use different coloured M&Ms to show how you can use your maximum allowance of £20,000 for all of your ISAs into each of these 4 buckets. So let's say you want to invest into a cash ISA. For cash, we're going to use orange M&Ms. So each M&M equals £1,000. So let's say you put £10,000 into a cash ISA. This means that you are able to spread the rest of the £10,000 amongst the other 3 ISAs. Next up, we want to put another £5,000 into a stocks and shares ISA. Next, we want to put the maximum allowance of £4,000 into a lifetime ISA. And lastly, we want to put a remainder into an innovative finance ISA. And let's not forget that the government will add 25% to your lifetime ISA. There you go, you've invested £20,000. £10,000 into your cash ISA, £5,000 into your stocks and shares ISA, £4,000 into your lifetime ISA with the £1,000 top up from the government, and £1,000 into your innovative finance ISA. As long as all of those come under less than £20,000, you can mix and match how you wish. Another example is you could decide that a cash ISA and an innovative finance ISA just isn't for you. Therefore, you invest your £4,000 into your lifetime ISA, and then you invest the rest of your money into your stocks and shares ISA. So there you have £4,000 in your lifetime ISA, topped up by the government, plus £16,000 in your stocks and shares ISA. As long as you only have one of each type, and those buckets come to a total of £20,000, then you can mix and match in any which way that you want. So now let's say that you want to open a stocks and shares ISA in 2020. you want to put some money into Hargreaves Lansdown, and you want to put £15,000. However, you also want to invest money into Trading 212, and you want to put 5k into Trading 212. However, because you're opening 2 stocks and shares ISAs in the same year, you can't do that. However, if instead you want to open 2 ISAs, one with Hargreaves Lansdown and one with Trading 212 for your stocks and shares ISA, you could invest up to £20,000 each year. But you would have to wait until next year if you wanted to change from your current provider, Hargreaves Lansdown, to invest more money into Trading 212. So here you have £15,000 invested in Hargreaves Lansdown in 2020. And then next, you have £5,000 invested into Trading 212, which you'd only be allowed to do in 2021. This is because you are unable to open 2 of the same ISAs in the same year.
So thanks for watching today's video, and I hope you found it useful to understand exactly what ISAs are, how ISAs work, and whether you should put your money into an ISA. As I've shown, hopefully if you've been using taxable accounts, that you will look at opening ISAs so that money in the future will be protected. I'm not a financial advisor, and you should always do your own research, but hopefully this has helped you understand a little bit more about what ISAs do and how they can protect your money. So if you've enjoyed this video, please make sure that you hit that like button and hit that subscribe button so you don't miss out on any further videos. And I'll see you next time.